Hey everyone, welcome back to your weekly market outlook. This is going to be the first full trading week for 2024, starting from the 8th of January 2024. So let's do a quick recap on last week. Let's talk about the inflation numbers coming out from the Eurozone. We do see a little bit of a pickup overall with the flash estimate for the CPI. It does pick up from 2.4% to 2.9%, just slightly below the consensus, but it's very near to approaching that 3% number for the Eurozone. Now, obviously, the focus for last week is definitely the employment numbers from the US. So let's break it down a little bit, because I can tell you straight away, overall, it is a very good number. So let's take a look at the NFP number first. So we have the previous number, which is the November number, was revised down from 199,000 to 173,000. And then for the December number, we got 216,000, which is higher than what the market is expecting at 168,000. This is a huge leap, right? We talk about December numbers, and the December numbers typically kind of a hit and miss, right? We sometimes see a huge drop, sometimes we see a little bit of an increase, but this increase here is a very significant increase. It takes the NFP numbers back up above 200,000 after several months, which is really important. Now, the average hourly earnings also didn't drop down. It was flat at 0.4%. Market was expecting a drop to 0.3%, which is also good. And the unemployment rate remained stable at 3.7%. Market was expecting a little bit of an increase to 3.8%. So all three combined, this is an overall positive number for the US. And market reaction during news releases was a little bit sus, right? We saw a little bit of a drop in all the other major currencies, and then a quick rebound. So the dollar kind of gave away back the profit that happened after the news release. So I think market was a little confused. What's really going on? How should this number affect the US dollar itself? Theoretically, it should strengthen the US dollar. And I think we are likely going to be looking at a US dollar strengthening, especially this week when a lot more traders are back in the market, right? So last week we saw that reaction. It wasn't really the proper reaction to the data. I think we are looking at the lack of volume in trading last week, so we didn't actually see the actual reaction. But just to double confirm with everyone watching this right now, the data, it's good. It's very good. In fact, we have a double revision for November. We also have a sustainable gain in the month of December. So for the wrap in 2023, I think the overall job numbers in the US, it's pretty stable and it's still pretty strong. So that number should strengthen the US dollar. I think the market was kind of either away for the holidays, they're not back yet, and we don't have enough volume to kind of make it a fair game for everyone. And I think the other part would be people waiting for the inflation number, which is going to get released this week, which is the topic for our next discussion, the CPI numbers from the US. So let's take a look at the outcome for the CPI number, or the consensus for the CPI numbers. So the CPI is expected to pick up. Again, the headline inflation is expected to pick up from 3.1% to 3.2%. If we get anything higher than 3.2%, then market expectation for the FOMC rate cuts in 2024 has to be reduced, right? So they need to reduce that expectation. And, if we see a little bit of an increase that's more than what the market is expecting this week in terms of the CPI, then we could actually really saw a very strong dollar. Because I think in terms of what the market has been pricing in for the rate cuts, I think it's a little bit mispriced. And we might see that correction happen during the release of the CPI numbers this week, right? In terms of the core CPI monthly growth for the core CPI, expected to remain stable, pretty much at about 0.2% growth. In terms of the monthly CPI growth, we're expecting a little bit of a growth from 0.1% to 0.2%. So that's going to be the main focus. I think a lot of traders are still waiting for that CPI numbers just to get, a little bit of a clue into what the FOMC is likely going to be doing in 2024. So this is going to be really important. And also this week, don't forget, we also have the release of the PPI numbers as well. So it could actually act as a counterbalance again. So I think main focus for a lot more traders are going to be the inflation numbers coming out from the US. Also from Australia, we also have the CPI numbers from Australia, expecting the inflation number to kind of drop down from 4.9% to 4.5%. We also have the Tokyo Core CPI, we have the Swiss CPI. So this is all about inflation this week, but the main focus is definitely going to be the US inflation numbers. All right, so let's take a look at the technicals. How does things react? And this is the dollar index, and we can see the initial reaction from the dollar index there. You saw that doji is starting to form on the dollar index pretty much on Friday. This is evident on pretty much all the other currency pairs as well. So we do see a little bit of a, not a confusion, but it's a little bit more of a hesitation. Should the US dollar strengthen or not? And that's basically what causes that little tall wick on the top and the bottom on Friday. This is on the dollar index. We're still being capped by 103. So I think in terms of major resistance for the dollar index, it's still going to be 103. And for as long as the dollar index is traded below 103, that would still act as a little bit of a resistance. But you can see on Monday, we're starting to pick up a little bit. We're going back into that ping range there. That's going to be our zone where we're expecting a little bit more resistance to start to build up for the dollar index. But again, it does point to the potential of the US dollar actually strengthening. Now, if we saw that, we take a look at that on the Aussie USD here. This is the Aussie USD. The only thing that's currently holding the Aussie USD from progressing any further is actually the fair value gap that we saw on December. This is actually going to be the exact same fair value gap that we're actually going to be looking at gold. This is the fair value gap that's formed on the 11th to the 12th of December 2023. Now, this is the only thing that's currently holding the Aussie USD from progressing any lower, and that's evident from that whipsaw that we saw on Friday. It does provide a little bit of support, and to be exact, where that level is, it is actually at 66.50. So we're looking at 66.50 to about 66 cents as a stronger support for the Aussie USD. But should it break below that, we actually don't have anything significant until about 65.50 level. That's why we do have that bullish order block for the Aussie USD. In terms of resistance to the upside, you can see the resistance there. Obviously, we have to weekly pivot. It's located about 67.30, and then we have the 67.50, and beyond that, we have 68 cents to 68.50, and that's also where the bearish order block is currently being formed on the Aussie USD here. So you can see that the Aussie USD, while it's technically still in an uptrend, it's being pushed lower. Now, to take a note at where the 66.50 is located, that's also about 78.6% in terms of the Fibonacci retracement. So this is currently being tested whether or not it could actually break support. And should it break below 66.50, 66 cents, then we could actually see further drop to the downside for the Aussie USD. And again, it goes back to the story that should the US dollar strengthen or should it not strengthen? Obviously, we have the numbers from the NFE numbers and the CPI. If we do see a little bit of an increase that's much higher than consensus from the CPI, that could really strengthen the US dollar significantly. It could really push the Aussie USD down significantly. Now, for the Euro USD, this one here is kind of in a range bound market condition. We have our key levels, we got our order blocks, but I think the main focus is definitely the 1.0850, 1.09 range. This is again the range that we've been talking about in 2023. We're very close to that level again. In terms of resistance, take a look at where the weekly pivot is currently capping the market. It's at about 1.0950, and beyond that, we still have 1.1. So market has not actually break above 1.1. This puts the Euro USD in a kind of a range bound market condition, but a lot more pressure to the downside. If we take a look at the RSI, it's starting to dip below 50 as well. It was flat last week and starting to dip below 50, so it might actually have enough momentum to actually kind of push and attempt to break 1.09, 1.0850. But for now, those two levels are still going to hold as stronger support. Now, for the pound USD, you can see a lot of this is currently trapped within a lot of levels here. There's a volume imbalance that's going to be at about 1.2750. That's going to be the first immediate resistance. In terms of immediate support, we have the weekly pivot at 1.27. Currently, price is at 1.27 at time for recording. So if you watch this at Any other time it might be different, but at time for recording it's currently at 1.27. Now this is Monday trading morning, and Monday it's attempting to break below 1.27. Should it break below 1.27, we do have a little bit of another block building up closer to 1.2625, 1.2650. So pound USD needs to clear off this support level, and below that obviously we still have a stronger support coming in at 1.26. So I think 1.26 would actually act as the major support for the pound USD, especially for this week. As you know, at the start of this week, this is going to be the key level to watch out for. In terms of resistance to the upside, we're going to be looking at 1.2750. Beyond that, we have 1.28, 1.2850. So there's a lot of support and resistance clustered together right now for the pound USD, right? With the pound USD, what we are eyeing for, the stronger support level is actually going to be at about 1.25, where we do have a little bit of an order block at 1.25. But to get there, obviously, there's 1.26, 1.2550, and to get to the upside, we have 1.2750, 1.28, 1.2850. So this is kind of actually, it's not range bound. Technically it's not range bound, but it's starting to lose a lot of momentum to the upside, and there are buyers and sellers building up on either side on the pound USD. So this is actually one of the hardest currency to actually trade at the beginning of this year, because we need to clear off a lot of these key levels for the pound USD to actually have more of a significant linear target on where to go to. All right. Then we have the Dow Japanese Yen. The Dow Japanese Yen, we always eyed for that 145, 146 as a key resistance. That still acts as a major resistance for the Dow Japanese Yen, and is still currently being capped by that level. Now, previously, last week, we were looking at 144 as that resistance. Now, 144 is now our immediate support for the Dow Japanese Yen, all the way down to about 142. That's also where the support one on the weekly pivot is currently located. Now, if you take a look at the distances between the pivot levels, the Dow Japanese Yen is not one currency to trifle with, because the range is so huge. The volatility is likely going to be wide. In terms of where your stop loss placement and target levels are going to be, we are looking at about 1 to 2 yen each. So this is actually one of the more volatile currencies out there. So if you're thinking of trading the yen pairs, be very careful, because you're looking at a huge risk involved here. You're not going to be looking at anything less than half a yen. You're not looking at anything less than 50 pips here in terms of stop loss. You're probably going to be looking at stop losses in the range of 50 pips to potentially up to 200 pips on the Dow Japanese Yen. So for the Dow Japanese Yen, if I were to give you the breakdown on the overview for the Dow Japanese Yen, this one here, it's technically still in a downtrend. For as long as it remains below that Ishimoku cloud, which is below 146, the Dow Japanese Yen is technically still in a downtrend. We do see a little bit of a recovery from the Dow Japanese Yen, basically on the back of interest rate differentials. Number one, we don't have any official confirmation from the Bank of Japan, right? So that would put the Bank of Japan monetary policy into that dovish stance. The second thing is that the market is kind of expecting that they could have mispriced what the FOMC could do, so they're trying to reduce the potential rate cuts in 2024. Obviously, that would put the FOMC into more of the hawkish stance. So the different stance here, again, that's basically what has pushed up the Dow Japanese Yen the past week. But again, if I were to remind you again, the movement last week is definitely not reflective of the overall market psychology, because last week in terms of volume, we don't actually have the kind of the maximum volume. We are lacking a lot of the volume. Market participants are still away from their New Year holidays, so I don't think it's a fair say to say that last week was a very strong indicative of the sentiment in the market. I don't think it represents the sentiment in the market as well at all. So just be very careful when trading the Dow Yen. Now, lastly, we have gold. Now for gold, this one here is actually going to be really tough because of that run at the end of November, where it actually created an all-time high at 2,144, right? If we take a look at the current positioning on gold, the thing that's supporting it is actually the fair value gap from the December 11, December 12 that was formed then, and it's still currently acting as a stronger support. Now, if we get rid of the fair value gap and we just go by the logical psychological numbers, that level is actually going to be at 2000 and 2020. So by right, these two levels are going to create a little bit of a demand zone for gold there. So we're likely going to be seeing gold being supported there. But if you take a look at the overall pressure on gold here, this is range bound. We tested 2070 and 2079 and it failed again at the end of last year. And currently price is unable to climb any higher than 2050. So if we take a look at last week's price movement, it does attempt to spike higher than 2050, but it actually never closed above 2050. So we do know that resistance at 2050 actually still holds. Now going by the current stance, we are likely going to see this correct a little bit lower to potentially towards 2020 and 2000, but it is no indication that gold is actually going to shift into a downtrend, because technically this is still above the Ishimoku cloud. This is still within a correctional phase. So just be very careful when you're trading with gold here, especially with how the market is actually going to anticipate what the FOMC is going to do. They might actually do another calculation. They might actually start pricing in for maybe less rate cuts should the inflation number pick up in the US. So with that, good luck with your trades, and I'll see you soon.